Monaco 64, home of alternative economics and contrarian views. October 2nd, 2018, Tuesday. Today I'm interviewing Carlos Perez Santala. He used to own a floor brokerage firm on the Comex, the commodities exchange, where we still trade the gold futures. And I know Carlos because I used to deal with him when I worked at MF Global. MF Global did not have a presence on Comex, so we used Hudson River Futures. So, Carlos, nice to talk to you again. We
Always a
are
pleasure.
we are always in contact as well, and you do watch some of my videos. Could you maybe tell us a little bit about your background before we go on to talk about how the gold futures market has changed in the last 10, 15 years?
Sure. Well, I started with Shearson Lehman. It wasn't called Lehman at the time. It was part of American Express back in 1983 on the floor of the Commodities Exchange. Back then, we were in 4 World Trade Center, and there were 4 separate exchanges on that floor. So I had a lot of experience trading, or working with. I shouldn't say trading. In the beginning, I didn't know a whole from trading. I didn't know anything. So I experienced energies, the softs, and the metals, and I ended up becoming a Comex member, as well as a coffee, sugar, cocoa member for a while, before I ended up starting my own Comex floor brokerage operation. By the way, I believe you and I met first. We were both with ABN AMRO for a short while, or I was for a short while, before you moved over to MF Global.
Yeah, I remember I saw you on your LinkedIn that you were at ABN AMRO. I was there
Yeah.
for a longer time.
Yes.
Yeah. Did we meet?
You're
I think I used to
well.
do
Was
sometimes go through on the floor.
I'm saying it? You did sometimes.
Yeah, not much.
Yeah, and I picked up. That's when I started my company. I started working for ABN to start an operation in the precious metals for them, and they were so slow in deciding what they wanted to do that in the 1 year I was with them, I just built a floor operation for them and decided to just go on my own because 90% of the business was mine, and I just
I see.
left.
Yeah, yeah.
So
I think at the time I had was one of the major Italian banks, and it's funny because all they did was roll 400 short positions of gold futures whenever they had to, and it was
right.
weird. It was a big bank, and I think I know probably who they were doing that for. Probably, maybe the Bank of Italy or something like that. Because I remember, when we used to get, oh, the margins went up. I called the client, say, oh, don't worry, we'll send the money. It
Right.
it, it seemed weird. But yeah, it's funny. I didn't realize that you were at ABN AMRO as well. So
Right.
there you go. And can you maybe explain before we go into how the market has changed, how the exchanges have changed as well? Because Comex still exists, but is not, you know, uh,
Right.
an exchange on its
Yeah,
own
that
anymore.
it isn't what it ever was.
Mm,
Even stock markets, nothing is what they ever were. In fact, rules of execution changed as well, on top of the fact that it's all done electronically, which has major benefits. Everything is done quicker. You see your price, you hit a bid, you get the bid right away. But then again, the prices are moving a lot quicker, so the volatility is a lot higher than it ever was in most markets. The gold market remains as liquid, if not more liquid, than it was back in the day when we were open outcry. Um, but again, like I said, the volatility is a lot higher. But then you have markets like palladium, which used to be a lot more liquid, but the high frequency trading and the high volatility has dropped volume and open interest there to a dramatic low level. It makes it a lot more dangerous to get involved. But back in the day, when we were open outcry, as you can imagine, anybody who's ever seen the movie Trading Places, the very end of the movie, that's that what they where they trade in that movie. They trade orange juice.
yeah, orange juice.
But they filmed that in what used to be the gold pit, and most of the guys in that movie that are standing there with Dan Aykroyd and Eddie Murphy are either gold traders or gold clerks at the time. That was just before I started working on the floor. Then years later, there are other movies that they filmed on the floor. It was a lot of fun to have them come visit with their cameras. But the yelling and screaming, it always seemed like mayhem, but it was more of an organized riot where everybody knew where to spot something. You could recognize people. There were times we had brokers who were able to trade with just a wink of an eye and a nod and be able to trade large volume with people. So we had the ability to do that, but the even more important part that we do not see now is the ability to see flow of orders. So on the trading floor, which used to be owned by the members, whether the members were the brokers on the floor, like I was at the time, or the clearing members. So a bank might have 2 memberships on the exchange, and I had a couple myself. So JP Morgan and I owned the same share of the exchange. Now the exchange is, well, Comex was bought out by NYMEX, which was bought out by CME, which bought everybody in the world, and now they're the one monolithic exchange with no competition really. And
who would you say
it's a public company.
Who would you say probably is the biggest shareholder in CME? You think?
CME, it would be the banks.
Yeah,
it would be the banks because it's easy cash flow. They charge fees for their data. Their fees for data went higher once everything became data dependent. Because all the trading now, since it's no longer open outcry, it's really all done digitally. So, for example, the largest commodity people in a bank are PhD mathematicians writing programs. They don't know the first thing about markets. They don't really care. They just know what happens with data and what's expectations of moves. And so that's why you see all this high volatility, the moves back and forth. The front running that happens due to the high frequency trading, well, they don't consider it front running because people aren't doing it. Computers are doing it, but it's still the same thing.
Yeah.
Back in the day, if you knew that there was an order coming in and you decided, you knew a sell order, large sell order is coming in. Now, locals, what we called locals, people who traded for their individual account and nobody else, they would stand in the pit, and every once in a while they would be in earshot of an order entering the pit to the broker standing behind them, and they would hear sell 100, sell 1,000, whatever the number was, and they would get short before the broker even got to turn around. And they were able to profit from that. A lot of times it didn't happen the way they expected, and the broker behind them was just looking to get even for a reason, and you had them get short, and they came in buying. So there were a lot of games that happened. These days, the high frequency guys, they see orders coming in because they're being fed, a lot of them being fed into the system at a slower pace than they move. So, okay, their orders get to front run. Somehow it's not illegal because people aren't doing it, computers are. One of the better stories is a few years ago, the CFTC has decided to create something called spoofing. Spoofing, they call it, is illegal because I'll use the real world example. What created the law or the rule was UBS had a large trader, their gold trader, Andy Flotron, who was once a client of mine, who was accused of spoofing and it being illegal. He obviously has committed a crime. And of course, the law wasn't quite illegal. They almost invented it as they arrested him. And they said that he never had any intention of having his 1,000-lot order filled. He would put a 1,000-lot sell order in so that he could buy his 100. Back in the day of open outcry, everybody did that all the time.
Yeah, and there was the danger that you might get lifted if you put the 1,000 lots.
You have to take a risk. And Andy Flotron was still doing the same thing electronically. But electronically, what was happening was the high frequency guys were front running his 1,000-lot order. So it was a lot easier for him to buy his 100-lot buy order when they front ran his 1,000-lot. On the trading floor, at Goldman Sachs, JP Morgan, whoever it was, would come in, offer 1,000 contracts. Most of the guys on the floor were experienced enough to know that's not real. As soon as they start selling 100 or 200, then we'll know it's real. Until then, it's not 1,000 contracts. There was the experience. The high frequency, the PhDs who write these programs, they didn't know, so they complained, hey, that's not right. He's putting in a false order. So back in the day, if they're a false order, you had to take some sort of risk to prevent it from being called false. So when Flowtron ended up going to court, he argued that he takes greater risk than any of these high frequency people because most of their orders are hardly ever on the screen for more than half a second, if even that long. And his 1,000 lot order that he got arrested before was on the screen for 2 minutes. There was risk involved.
Yeah, that's
because
more.
It was sitting there.
Yeah, he could have. 2 minutes is quite a long time.
It's an eternity in the high frequency world.
Yeah.
So his case got thrown out, and he was like, "Oh, justified," and all that. So,
what about the maybe there's a lot of talk about market manipulation in the futures market, also on the LBMA, and also the overall denigration of gold by the mainstream. And I always remember when I worked in the futures market. I didn't only do gold, but I follow gold a lot. And I remember because on Comex, before it went all electronic, you had what was called, I think, Project A, which traded before the floor opened at 8:20 New York.
We would have, well, before it went fully electronic, we had, what I forget what we called the system. We had the overnight system that was created as soon as the
Globex or Project A? Yeah,
Globex. Yeah. Globex was. It wasn't even Globex. There was another name. Yeah. Comex was the first one to have this electronic trading platform that was forced into the marketplace. Comex and NYMEX together. Yeah. Due to the World Trade Center collapse. Yeah. So because of that, we needed to give people a way to be able to trade more flexibly and not have to worry about the exchange being closed for a week. So that made some sense. But
I remember, though, that the official regular hour opening in New York was 8:20. And prior to that, it was trading electronically in London. And let's say the market was up $5. And then lo and behold, almost every time a few minutes before and on the open of Comex, the market would drop. And do you remember
regularly?
And
people would show up to work at 7:30 a.m. and get short without even thinking about it. And just get short. Don't worry about it. It's not that much risk. And 9 out of 10 times you profited because after 8 a.m. New York time, the volume on the electronic system began to wane as all the opening orders started to come in from all the hedge funds and trend following funds. So people were trying to position themselves. Next thing you know, large banks in general, because they were the largest traders around, would hit the system when there was less liquidity, and the market would drop, and then the market would open up, and they would buy anything that was left on the opening. And so the opening orders would come in and start selling, and because the market had become a down move prior to the opening, so these short-term trend followers would follow that move. They'd sell the opening. The banks would get flat, or the speculators would get flat.
Yeah.
And when I say banks, I don't mean to say banks as the big monolith that they are, because a lot of banks trading isn't always speculation. Most of the time, it is not. Especially these days with all the Dodd-Frank laws and all the compliance issues that have come in, where they have limited their trading desks. There are no longer the big traders that there used to be at all these banks. So they still have traders because they need to provide service to their large high net worth clients, as well as their the mining companies where they help.
Do you think maybe because I saw a couple of years ago that the BIS, for example, they had an account have an account with the CME, and the CME is providing accounts for all the central banks. Do you think they could be doing the gold trading for instead for the big bullion banks now instead?
Well, yes, the Federal Reserve Bank, BIS, we can't ever know how and when they get involved. We expect that they're not in all the time. Whenever you see a strange move, say a bullish news item might come out for gold, whatever it is, and gold begins to rally, next thing you know, gold drops $10, $20 out of nowhere. Why? Well, that's when I believe it's manipulation, because it doesn't make any sense.
It's like management of perception, isn't it? It's like trying to...
That's exactly what we've always thought it was. And so you just, you take your lumps and survive the next day. But the world isn't as easy as it used to be, because it's never as it's never the same type of reading of the market as it used to be. The historical norms just don't fit all the time anymore.
What
You know?
about when you were on the floor? Did you notice like unusual activity, like let's say the market was going up, and all of a sudden maybe J.P. Morgan or Goldman Sachs came and said, offered 1,000 or two
Oh yeah,
thousand lots?
no question about it. We saw that, and before we even moved to our own building, which I think it's still called the CME building, right across the street from the World Trade Center. When we were in the World Trade Center, the gold pit was right next door to the dollar index pit. And am I there? Because I think
Yeah, it just froze. Okay, now.
Sorry. And the dollar index pit, back when we was all a vocal exchange, there was a lot of rumor. Sometimes you knew who to believe, sometimes you didn't know who to believe. In the electronic world, you don't hear that. It isn't nearly as easy to hear who's doing what. So in the dollar index pit, we might hear someone say the Fed's involved manipulating the dollar because the foreign exchange markets were all in touch with them. And so the dollar index guys might come running into gold, knowing that gold's next, because they would affect U.S. dollar rates before they would try to affect the gold market.
Yeah, and
then as soon as they would elevate the dollar, then they could come in and hit the gold a lot easier, because people would say, "Oh, we're just going with the dollar."
Yeah, and the other thing as well is a lot of the foreign exchange traders, they also deal in gold, because gold and silver are, if you look on the Reuters page, FX, XAU,
Right.
XAG, it's all, they trade it as a currency. So
It's
it
all
makes
there,
sense.
but you know what? These days, I believe most of the banks have their gold trading on their foreign exchange desks. But before everything went electronic, gold was on the commodities desks. They generally sat with the energies, the base metals, and maybe even other hard assets. But they were rarely next to the foreign exchange market, which was really unusual.
But that's interesting, that story about the dollar index, and that the Fed might be intervening.
Oh, sure.
So if the dollar was getting hit hard, the Fed would go and help the dollar up, and then someone would just come and hit gold as well.
And we don't even know if it was real, but because it was all vocal, there was things like that would move waves. I'll tell you what, before people even trusted each other on the floor, because back when I started in '83 on the trading floor, we had what were called Quotron machines, which was basically a page on a monitor, a video monitor, that showed prices, last price, and change, last price and change. That's all you got. The black screen with the green letters.
I remember that, yeah.
Okay, so the Quotron listed everything alphabetically. So back in '83, silver, soybeans, and sugar seemed to move together because they were right next to each other on the screen. The strangest reasons people trade. It didn't make any sense. But because the three S's were right next to each other on the screen, people would look at the screen quickly and see that it was down, and they'd sell. Yeah. Oh, shit, that was silver that was lower. Okay, I got short sugar. Well, let's see what happens now. Yeah. And that happened a lot, Yeah. And, of course, as time progressed and technologies changed, very many things changed. There used to be people who would sell their technical expertise on the trading floor. And there was one guy in particular who had probably, I'll say 75% of the locals used to buy his support and resistance numbers. And his numbers were spot on. This guy made a living just selling his technical numbers. He decided to go on vacation for 2 weeks once. In those 2 weeks, he lost all his business because they didn't have anything else to buy, and they went and bought somebody else's services. And when he came back, well, they didn't lose it all. I think he lost a few. And when he came back, he had fewer clients. And when he sold the numbers didn't work as well because not as many people used them.
Yeah, they were following someone else's numbers.
Right. When 75% of the people were following his numbers, they worked great.
Yeah, that's strange.
So technology has improved a lot of things at the same time that it's altered the way people trade. Yeah. And it always will.
And so what about let's talk about, because the Comex floor or exchange was in the World Trade Center. So do you remember what happened exactly on 9/11? And were you there? Is it in the basement of the World Trade Center or?
The
Was
Comex
it
at the time of the World Trade Center of 9/11 got hit. We're talking about. Are you talking about 1993 or 2001?
2001?
In 1993,
I
that was in the
remember.
basement.
Oh, I
That
see.
was a bombing that they tried to take the towers out from underneath, and a
Yeah,
truck blew up.
yeah.
A couple guys I worked with, they got hurt that day. They were just leaving work, but that day was that was an interesting day. We evacuated the buildings and all that.
So it
So
was.
now in 2001, we were no longer in the World Trade Center. Now we were across the street on the Hudson River, just one building away.
Oh,
And
so you weren't really in the World Trade Center.
we weren't in the buildings anymore. No, we were
I
across
see.
the street, a building away. So when the first tower got hit, the market was open.
Yeah.
I forget the times, 8:30 something. It got
It
hit,
was 9 o'clock,
and
I think. Yeah.
9 o'clock was the second one.
Was it?
9:01. I remember
Okay.
that one
Yeah.
because we closed. So
Okay.
the first tower, it might have been 8:40. So we were open for a little while. It was an absolute quiet day. Next thing you know, every one of my phones is ringing.
Yeah.
I pick up a phone, and one of my biggest customers, buy 1,000. I pick up another phone, another large customer says, buy 1,000. And then I pick up another phone, and one of my good customers from Man says, get the hell out of there. The terrorists are back. We're in danger.
Yeah.
Leave. Hang up the phone. Don't even work. I said, what happened? He says, the World Trade Center. They've attacked the World Trade Center. So now, at that time, Comex and NYMEX were across the street, but Coffee, Sugar, Cocoa, Cotton, OJ, they were still in the World Trade Center. My cousin has a company at the time in that I was associated with in coffee. So I'm supposed to be helping my client figure out how their prices are going because I gave the order to my partner, and I keep them on my ear, and I'm calling and calling, trying to call coffee, find out what's going on with my cousin.
Yeah.
And my client, she starts yelling at me. What the hell's the matter with you? What's going on? I've never heard you like this. And I tell her what I just found out. She said, all right, I've got 100 different brokers. I'll call everybody, find your cousin. You worry about my order. We
Yeah.
did that. She gets back. She says, no answers. Nobody's touching. Nobody's answering the phone.
Yeah.
You know, and from my cousin, I found out as soon as the first tower got hit, everybody ran for their lives.
Yeah.
So now we still traded. We were very busy. I did I don't know, back in those days, 10,000 contracts for a brokerage firm like mine was a lot.
Yeah. 10,000 is a lot. Yeah. So
Between
that's a thousand. 1,000 contracts, 100,000 ounces, just to let
Yes.
people know. Yeah.
So we between the first tower, then and the second tower. Okay, so what happens? So now the first tower gets hit. Then it's just an airplane. Just an airplane is what everybody says, right? Because I think it was a week or 2 weeks before, a small Cessna hit the Empire State Building and crashed. So everyone thought, oh, it was just another airplane. Why airplanes are hitting buildings? Who knows? So next thing you know, the first guy who bought 1,000, he sells the 1,000. Boom. And so is the other customer. And next thing you know, second plane hits. They come on. They want to buy. Now, in between, they're not the only orders. There's all these other orders happening. The market's going crazy. As soon as the second plane hit, within 30 seconds, we're told the market's closed, stop trading, get the hell out of the building.
Yeah. What about, there's a lot of talk about how a lot of gold disappeared from the World Trade Center. But you've just told me before, when we were talking before the interview, that it wasn't Comex gold. It was someone else's gold, right?
It might have been Comex registered.
Yeah.
But it was Swiss Bank's vault.
Oh, I see.
So the gold could have belonged to anybody, may have or may not have been registered to Comex. Some of it might have been. But all that gold that was in the Swiss Bank vault in 4 World Trade Center, so it was underneath the pile of the buildings collapsing. Within the week, they had military surrounding that area, making sure that nobody dug that deep. Until once the gold was discovered, it was moved under armed guard. And so it didn't disappear. Yeah. If anything disappeared as far as gold goes that day, it's all the watches from the jewelry store that didn't get touched. Because when the buildings went down, the oddest thing, not every building in the World Trade Center structure, there were 7 buildings in the World Trade Center structure, not all of them collapsed. 5 World Trade remained intact. In fact, there was a bookstore that it looked like the day after tomorrow type situation, where cups of coffee, the breakfast is still warm at the cafe. and people left their books open. There's just, where did all the people go? That's
Yeah.
what the bookstore looked like. But there was a jewelry store right next to the bookstore. Who knows what happened to that jewelry? You
Yeah.
know, that's the
What?
kind of thing that disappeared. But as far as true vaulting gold, it didn't go anywhere.
What about like just to finish off now the interview? How much of a physical market is the Comex really? Because we're talking about that in the
Yeah, that's
pre-interview.
it's the exchanges in general, and stock exchange being very different. I'm talking about commodities
Yeah.
exchanges, futures exchanges. Futures markets are pricing mechanisms. So, although you can, and some people occasionally do, take or make delivery through the exchange, it rarely ever happens. It happens because of rule of law. So somebody might have a long position on first notice day that they forgot to roll, and all of a sudden they stop out a sell order. So now they're supposed to take delivery. Generally, no delivery ever happens. He lets the exchange know, I need to retender, and the next day that same stopper is an issuer, and it could even be the guy who issued it to him the first day takes it back, and the guy loses carrying charges, insurance. There's all sorts of stuff, but it's a minimal loss considering that he doesn't have to put up all that money to take delivery. Most futures exchanges, I'm sorry, most futures contracts just die or get rolled.
Yeah.
So I think in the metals market, it's less than 5%. In certain other markets, like the grains, it might be a little bit higher than that for delivery, but it's rarely ever over 5% for any commodities markets. It's just a pricing mechanism. So you'll see the futures markets decide where prices should go before you'll ever see physical moving. So you might see, and we read about it all the time. I hear you talk about it often on your podcast, where retail coin purchases are very high, and they have been for years now. Well, how come that's not affecting the price of gold?
Yeah.
Well, because the retail guy might be paying over and above cost anyway, and the guys involved in actually moving the large amounts, and we're talking tens of thousands of ounces of gold at a time, they're pricing the market. So it's a hard call. So it isn't always what makes sense fundamentally.
So
No.
what if like in the 70s and early 80s, the Hunt brothers decided to go and start taking a lot of delivery? What if someone tried to do that today? Do you think the U.S. government would be all over them and stop them? The
Well, here
CFTC?
you may not remember, but what was his name? Marty Armstrong
Yeah.
got crazy because he had every reason in the world to believe that silver belonged at $4 at one point. And somebody was buying. They kept buying and buying and buying. And next thing you know, they were taking delivery. And he was getting upset. So he called the federal government and he complained, find out who it is. So the CFTC finds out who it is. They called Citi. Citibank was the buyer. Citibank calls the client, who happens to be Fibro at the time. Fibro, why are you doing this? And they said, well, we're taking some on ourselves, but we're doing it on behalf of a large client. Who's your large client?
Warren Buffett. Yeah.
Do you think Warren Buffett might want to tell the world that he's buying silver? Well, let's ask him. Okay, yeah, sure. Warren Buffett said, I don't care. I'm almost done. So he did. He took silver at that time from, I think it was 470 to 720. And everyone thought it was going to keep on going at that time because Warren Buffett's long. Little did people realize silver could have gone from 720 to zero, and it would have meant nothing to him because Coca-Cola moves $3. It's worth more than his entire silver position. So he didn't get out of that until much later, if he got out at all, from what we understand.
So why would Martin Armstrong report that? Why was he so upset that someone was taking delivery?
He was one of the largest manipulators of the price at the time. He was a very, very large trader. I forget the name of his company, might have been Princeton Economics.
Oh, yeah.
He would enter the market, and he would do what today is called spoofing. He'd offer 1,000 silver, which is ridiculous.
Yeah.
A tremendous amount of silver.
I know.
And so he'd offer 1,000 silver, and the market would come down. Then he'd offer another 1,000, and people say, "Oh man, he's serious." And next thing you know, silver's down 20 cents, which these days seems silly, right?
Yeah.
But back then, 20 cents was a very large move.
On a $4 price. Yeah.
I'm talking about days where silver might have a 3-cent range, and this is how people made a living trading inside of that. Gold if we had a $2 range, we were happy.
Yeah.
You know, and that today is not even the first minute of trading. So
yeah. So interesting that Martin Armstrong, because he was in jail for a while, and he comes across and he wrote a lot about how Warren Buffett used to manipulate things, but you're telling me that he was the one who was manipulating it. So
they both, you know,
yeah,
when
they're
you're
both.
that big, that's what you do.
Yeah. Mm.
When you're that large a trader,
Yeah.
anything you do is seen as manipulation
Yeah.
because you're moving the market just because you're participating.
Okay. Great, Carlos. It was really nice talking to you.
I hope it was helpful.
Oh yeah, very helpful. Thank you. And
if anybody has any questions,
yeah,
they can send them to you.
Yeah. And what are you doing these days exactly then, Carlos?
Well, I have a couple businesses because the futures markets margins collapsed.
Yeah.
I just started up my own IB.
Yeah.
So I'm clearing. I have clearing clients in the futures markets. They trade for themselves. They execute themselves. I just get a little taste to help clear
IB is introducing broker, yeah.
An introducing broker in the futures world. Yes. And so with that, I'm taking on retail clients because the large firms, the large banks, large clearing firms, they don't want retail clients because the cost of compliance is just too much for them. So they don't even like to deal with it. So I'm looking to pick up the people who are being shunned away. And at the same time, I'm working in the commercial real estate investment world, which to me has parallels to gold because all the economic reasons to own real estate are similar. Of course, gold is fungible, real estate is not. Real estate pays you while you're holding, where gold doesn't. You know, there are differences, but the same economic principles behind your decision to buy it in the first place are still there.
Great. Have a great day, Carlos, and thanks for talking to us here. And
all right,
maybe we'll do this again in the future.
All right, Maneco 64, the best. Thank you.
Thanks.